Tata Steel, one of India's oldest and most global metal giants, just reported Q1 FY26 numbers that show two very different worlds. One, a stable, growing India business, and the other, the European unit under significant transition. With an ambitious green steel strategy, capacity expansion in India, and a long history of resilience, the big question is, can Tata Steel shape the next era of steelmaking? Welcome to AlphaCall. I'm Radhakrishnan Chonat from Alpha Street, and in this episode, we go beyond the numbers of Tata Steel's Q1 results to unpack the business momentum, strategic shifts, and what it means for investors tracking infrastructure, commodities, and sustainability. Founded in 1907, Tata Steel operates across India, the UK, and the Netherlands with integrated steel plants, mining operations, and downstream facilities. While steel is a cyclical business, Tata Steel has stayed relevant by continually adapting from consolidation in India to bold decarbonization goals in Europe. The company is now at a strategic inflection point, scaling India capacity to 40 metric tons per annum, transitioning UK and Netherlands plants to greener electric arc furnace EAF technology, and balancing capex 3,829 crore in Q1 with debt management, which was about 84,800 crores of net debt. Now, let's look at the financial highlights and try to decode the consolidated numbers. Revenue 53,178 crores, down 5% quarter over quarter, primarily due to lower volumes. EBITDA 7,456 crores, up 15% quarter over quarter. Adjusted EBITDA per ton came in at 10,470, a solid recovery from 7,810 last quarter. Net profit 2,007 crores, nearly double versus Q4, but still modest given global headwinds. India operations accounted for 65% of group EBITDA with strong realizations and improving cost efficiencies. So, what's the takeaway here? Despite volume constraints in India due to the relining of its blast furnace at Jamshedpur, Tata Steel maintained margin discipline through a focused cost transformation that delivered 2,900 crores in savings this quarter. Now let's look at India versus Europe, which is basically a tale of two markets. In India, domestic deliveries were stable at 4.8 million tons, with strength in retail and auto. High-end auto products sales reached a record Q1, supported by approvals from global OEMs. The new capacity is coming online at Kalinganagar, 5 MTPA, and Ludhiana, 0.75 MTPA EAF, alongside a 2.2 MTPA cold rolling complex. Retail brands like Tiscon and Ashiana continue to expand the digital reach. Now, if you look at Europe, especially Netherlands and UK, Netherlands EBITDA was 612 crores, a recovery from previous quarters but still under pressure from energy costs and scrap prices. UK operations posted negative EBITDA of 468 crores, continuing the drag on consolidated performance. Now, the transition to EAF in Port Talbot is underway, backed by 500 million euro from the UK government. But the payoff is still a few years out. Now let's jump to sustainability and the green steel push. Tata Steel aims to become net zero by 2045, ahead of many global peers. In Q1, the key milestones included groundbreaking for the EAF in the UK, advanced discussions with the Netherlands for similar decarbonization support, and in India, Pilot initiatives like Hisarna and EC Melt are being tested to lower coke usage and emissions. India's first carbon bank launched to enable carbon credit monetization also. Now, why this matters? Steel accounts for 7 to 9% of global CO2 emissions, and companies that lead in green steel will likely benefit from regulatory support, ESG flows, and premium pricing. So, what's the outlook and risks here? In terms of opportunities, we see strong tailwinds from India's infrastructure and housing push. Strategic retail growth through digital platforms like DigECA for MSMEs, and cost discipline and integration synergies from Neelachal and Meramandali. Risks? Europe. Yes, European operations continue to burn cash. Transition to green steel will take time and capex. Global steel prices are volatile. Spot spreads saw a brief rally, but again, they are softening again in July. And debt remains elevated at over 84,000 crores. Manageable, but definitely needs monitoring. So, the key takeaway: Tata Steel is in transformation mode, using India growth to fund and buffer the reinvention of its European business. So, Tata Steel's Q1 FY26 story is one of, let's call it, resilience, recalibration, and reinvention. And the next leg of the journey will test its ability to execute a green transition without losing sight of profitability. And that's a wrap on this Alpha call. So, what do you think? Can Tata Steel remain competitive while going green? Do drop your thoughts in the comments. I'm Radhakrishnan Chonat from Alpha Street. Thanks for tuning in. And as a disclaimer, this episode is for information purposes only and does not constitute investment advice. Alpha Call and Alpha Street are independent and not affiliated with or sponsored by Tata Steel.